I hope, folks, hope we are live here. I am David Russell, Global Head of Market Strategy at Trade Station. It's great to be with everyone. Today, we're going to be talking about option strategies for earnings season. Now, we're going to be sharing a few links in the chat. If you want to check those out, we're going to have some downloads available for you, which include the slides. Just going to show you a few disclosures first. We'll walk you through several things using the Trade Station platform and Options Station Pro. All right, so the first thing we're going to do is we're going to talk about the ways to kind of be preparing for earnings. One of the nice things about earnings season is that we know when the catalysts are. We don't get surprised by it, and it gives us the opportunity to plan things and to use options, which are obviously pegged to certain levels and certain dates. So it's a great opportunity for using options. We're going to talk about vertical spreads, credit spreads, covered calls, and looking for some different pre-earnings setups and then things to do after earnings. I've noticed that recently some of the opportunities come after earnings season more than they do before earnings season. So the first thing I want to do before we even move on to these methods is first I want to go over my TradeStation platform and show you a really just quick setup of kind of where I kind of see things in the market. Now, we do webinars every Thursdays, and I use this workspace sometimes for these webinars, and I will just quickly show you. When I look here at the S&P 500, is what we're seeing here in some ways is there's a level at 5,500 that the index went down and hit on Friday and has come back from. We have the rising 21-day exponential moving average, and we also have RSI dipping to about 50, kind of the mid-level. So the things that are interesting to me here is the fact that I've noticed a pattern. I've talked about a lot of my other webinars about when the S&P has been moving to new highs, when we basically see RSI essentially staying over 50. It shows something of a strong uptrend. It reflects that there's not significant pullbacks in the market. We've also seen the 9-day rate of change not really go much below zero, maybe -1 for a short time. You'll notice when the market did have a deeper pullback, it went negative and it stayed negative for like over a week or two, and then it accelerated lower back here in April. At this point in time, it's more of just like a modest pullback. So these things right now kind of suggest that the market essentially has some momentum in place and holding the 5,500 level that was just kind of a high back here at this point in June. It's also just a nice round number. So these things all kind of coming together. I also set it up to show new 52-week highs with these white crosses here. So I wanted to just kind of briefly show that to you. It's just something I'm kind of seeing here. The one thing I'll point out is that we have a GDP report coming on Friday, and that will include some information potentially about inflation that could be important. And we're also basically have it's just an overall situation where there's something of an imbalance where there still appears to be not a lot of selling pressure in the market overall. Now, if you go to the zip file, which we shared in the chat, this is what it looks like if you open it. Might look different to you a little bit, but it has 3 items in it. These are the slides right here as a PDF document. We have the ELD, the easy language document, and it says options for earnings season July 2024. If you double click on it, it will open up and it will allow you to import some studies. I have these, so I'm not going to do it, but if you import these studies, it will then, those will be on your system for when you open the workspace, which is the other file here, which is the TSW TradeStation Workspace program or file right here. And that's what I'm going to be working with. So I wanted to just show you how to import those studies if you don't know how to do that. If you've been on a lot of my other webinars, we have used these studies other times in the past. All right, so for me, as an important part of earnings season is the kind of an important part of trading options is to recognize that there are some stocks that are kind of liquid for trading options, and then there's other stocks that are not. And very often it's kind of useful to start with knowing the kind of stocks that are going to be the most active. So otherwise you get some kind of illiquid stocks. Sometimes you get a lot of these stocks that even a stock like Berkshire Hathaway or Travelers in the S&P 500 barely trades any options. Might be in the Dow Jones Industrial Average, but it's just not active. So it's good to kind of start by looking for those kind of stocks that trade a lot of options. So the way we're going to do that is we're going to go to apps and we're going to go to Scanner. And with Scanner, it allows us to find the entire universe of stocks that are out there. And just to make it a little bit easier to see, I'm going to go here to window and I'm going to make the font a little bit bigger. I'm going to set them all to like 16 so you can see what I'm doing. All right, nice and big. Now, The first thing we're going to do is we're going to go to add a scan or new. And I'm going to just call it, I'm going to give it today's date so I can find it easily. I'm going to just call it active underliers. Now, the reason why we're doing this is to kind of look through all the stocks that are out there, because there's a lot of companies you might not think about, or you might overlook when you're looking for potential options trades. We're going to go to new scan. We're going to go to all stocks here. And then we're going to go to next. And then we are going to go to, I already have these as default, which I'm just going to remove to make it easy. I'm now going to go to scan criteria right here, and I'm going to go down to indicator. Now this will bring in the set of indicators that's available on TradeStation, and there is one that's already set up here, which is called volume all options, volume all ops, right? And now what I'm going to do is I'm going to change this to average. So the first number will simply show the options volume today or on any given bar if you're looking at on a chart. But if we set it to volume all average, it will show us the trailing average of options at volume. If we want to see the history, if we open that up, it's going to show us over the trailing 20 days, which is pretty much going to show us the monthly options volume in something. And then what we're going to do is we're going to set the operator to greater than, and then we can set it to 25,000, no comma, 2512 zeros. And now we're just going to go ahead and hit run. Now this will take a while to run, so we're going to just leave it alone for right now, kind of make it easy to see. And now we're going to do is we're going to go to our next slide, which is method 2. TradeStation's radar screen tool can track a range of indicators on a provided list of stocks. So Scanner will find stocks for you, and radar screen can deal with stocks and analyze stocks that you give it. So we have a custom indicator called average options volume in the included workspace. It was one of those studies that you would have imported in that easy language document. So what we're going to do here is we're going to go over and just import an easy list of stocks. So right now I'm going to go to this workspace. First, I'm going to close this one. And we don't need to see this anymore. And then we're going to look at the one that I provided. And you'll notice it has 2 tabs. It has pre-EPS or pre-earnings prep and post-earnings alerts that we're going to get to. So I'm going to go now to data, add symbol list, NASDAQ 100. And now it's going to bring in the NASDAQ 100. Now, what I can do is you'll see here that I can then sort on average options volume. Now, average options volume is very similar to volume all ops, the one that we just put in the scanner. The difference is that I've customized it with some easy language that allows me to kind of highlight those stocks that trade a lot of options. If you want to learn more about easy language, Jesus Nava often gives a lot of educational information on that is very useful. I learned a lot from him. And those indicators are things that you can customize and make useful for you. So essentially what this does, and it's now importing a lot of data. So I'll just kind of show you what's happening here. This essentially has a few different indicators on it. This is the main thing that's doing the heavy lifting for us in this webinar. It's called Next Earnings Date Studies, and it's going to show us the upcoming earnings for all these different stocks. So I can now sort on the days until earnings, and you'll see here that we have Alphabet reporting very soon, for example. All these things are right there in front of us using this tool. Now, what's interesting about this is you'll also notice that there's companies that trade lots of different options. Like, I mean, I even ROP, I did not even know that this is a kind of weird industrial stock, but I did not even know it's in the NASDAQ 100. It barely trades any options. So what we can do is we can sort on average options volume, and we can just say, I only want to see things that trade 25,000 contracts a day. I go right down here. I can right click and I can go to data, add label row. And now I've basically broken them off, and I can now go back and sort. So now I can sort on days, and it will allow me to go down and see, here's my list of active stocks. And we're going to see Alphabet, Tesla, Advanced Micro Devices, all nice order like that. So this allows us to very quickly go through and find those companies that trade a lot of options. I want to also tell you that this includes one of my custom studies that I've shared with customers in our my market trends webinars on Thursdays, and something I think is very interesting, which is I call it MACD cross days. I mean, it's a very simple title, but I give it that so it fits in radar screen. What this does is this tells me if MACD is rising or falling on these individual stocks. So if I look at something like Gilead Sciences, you can actually see that this stock has rising MACD. Now, what I've noticed is that very often stocks will be trending in a certain direction with MACD um, before a move happens. And so it's interesting here to see that this MACD is rising. And I've often found that if you look at companies, one recent one that was interesting that I was writing about, but if you look at this company, Fiserv, FI, they basically had MACD was knifing down like this when earnings came out. And you'll notice that it was not able to follow through. Now, this is just, not a very well-known stock, but it was a recent example that was very striking. And some of the things we're going to get to in a later slide is precisely trying not to get sucked into things like this. And so the idea is that MACD cross days can help you find stocks where you don't have a sharp drop in the short-term momentum, because that's part of looking for options trades. Sometimes it can be beneficial to look for things that have that kind of short-term direction moving in your intended direction, and to just kind of realize that MACD can be a useful way to find that. So we customize MACD and we put it into radar screen, and basically that's what this tool allows us to see. I want to just kind of explain that. All right, so as we kind of look at this now, what we can do is I'm going to kind of get back to this. But the basic idea is we can be looking here for stocks if we're looking for potential longs. One of the things that I mentioned in my later slides is we want to look for things that have space to the upside and MACD that is flat or rising. So it's interesting to see something here like PayPal. Now, this also shows where our previous earnings reports are with this markup. And you can see here, this is kind of interesting that it tried to gap higher in the last earnings report. But interestingly, you can see it was at the top of its range. It did not have space to the upside. And so, by the way, this is, I'm mentioning things that I'm going to now cover in slide 15, just so you know. But this is something where you can be looking for MACD and space in a given direction to kind of build your option strategy. All right, now I'm going to go back over here and we're going to look for, here's our underliers. Now I can tell you that this scan was interrupted by something. I probably pushed too much data through it in the middle of the day, so it did not complete. It can be a good idea to set this scan to run overnight, or set it to run at like 5 in the morning or something. It did not finish, so I'm just going to, I just wanted to show you how to set it up, but you can see that it has quickly identified a lot of the major stocks. What's nice about this is it will find stocks that are not in the major indexes. Like this stock, Affirm, AFRM, is not in the big indexes. It will find things like, AI, which is this, it's an AI software stock, is not in any of the big indexes. So this can find stocks that have active underliers, that have a lot of liquidity, that are not necessarily in the indexes. So you could, for example, just copy this, click on the actual column header, hit Control C, and you could like go over here and you could just, I could just paste it, for example, and it's that easy to work with. And I could just call it like, I can put in a little squiggle and say from scanner. And now I've given it a label row. And the squiggle is the little, I'm not sure what it's called, but it's the little squiggle thing to the left of the 1 on your keyboard with a shift. So that is how you create a label row. And so I could import that list and I could be looking for things using that. So I mentioned here the average options volume custom indicator. The one other thing I'll tell you is you can customize this. This is set with a threshold to highlight when you have volume over a certain threshold. If you go to studies, edit it, you can then go in and change the threshold. It's set to 10,000 contracts, but you could set it to say like, 50,000, and then you'll see the different stocks, get highlighted or don't get highlighted. So it's just another little method you can have. And the reason I like this is I might have a huge list of stocks. I'm going to just kind of sort and say, all right, who's reporting? I can look down the list and then I can start to see the ones that are active. It just jumps right off the screen and makes it easy for me to see. Now we're moving on to the next one, planning for earnings report. So I showed you here the next earnings date. Dates can be sorted once populated, and they can be copied from scanners. Like I said, they can be imported from indexes or list or provided directly. Like you can just have a list of stocks. All right, now on chart analysis, the next thing is this chart analysis here, it already includes the next earnings date. Now, if you want, I'm going to go over here and show you on a new chart how to add it. You might want to do this. If you use the workspace, it will work. It should work on yours when you bring it in. But if you want, you can add it yourself. You might want to just realize that you might want to kind of tweak it a little bit. So, for example, we would go to studies, add study, and then we would go to next earnings date studies. You can just hit end to jump to it. Next earnings date studies, bring it in. And then what's interesting here is if you go to inputs, you're going to notice these different values. Now, I like it to be kind of in the middle of the screen. So what I can do is I can adjust these different values. So for example, I can make the font bigger. I can also, for example, make it, this is a distance from the right. So 100 means it's going to be on the far left. I could set it at like, something like 70. I like it at, kind of a third from the left is where that will put it. And then I can maybe put it a little bit off the top. I could put it instead of 100% from the bottom, I could put it at 90% from the bottom. Another thing with this is that it will highlight when you're close to earnings. And this top value, change text, color, number of days, that is the threshold to how close to earnings for it to highlight. So it by default is set to 5, but you could change it to something else and it will make the actual text a different color. So I'm now going to hit OK, and now you'll see it come in, and there it is. Now, if I actually put in a stock like Alphabet that reports soon, you will notice that it shows up in orange. A stock like NVIDIA that reports farther out in the future, it shows up in this gray. So that's just an example. You see, I made the font bigger. I moved it from the right and from the top, and that's just some little some kind of customization that you might want to be able to work with. But so now I'm going to start getting kind of more details of options. And so I think it's important to just really quickly kind of review and remember that call options fix a purchase price and they gain value, or they can gain value when stocks rise. The most important thing is, well, at least from my perspective, when I look at options, is I always look at their delta, and they have a positive delta, which means that they move in the same direction of the stocks. If it moves, if a delta is, if it has 50 deltas and a stock moves $1, the option will appreciate by 50 cents. And that's always, an important thing to remember, because when you have multiple, a multiple leg option strategy, like a vertical spread we're going to get to, it will behave as the net value of those two deltas. You can have a call and you can sell it against existing stock, or you can sell it against another call. Puts fix the sale price, so they appreciate when stocks decline in value. They have a negative delta. So when you look at them, that delta is negative, which means it's the opposite. It's like an inverse correlation. If something has a correlation of -1, it moves in the opposite direction. Well, delta is always going to be negative on puts because they move in the opposite direction of the underlying price of the stock. And they can be sold against other puts in vertical spreads. Okay, now, what's interesting is implied volatility moves around during earnings season or as earnings approach. And TradeStation makes it easy to see some of that. So there's an indicator here called implied volatility. This is the abbreviation of it. And it allows you to see on your chart what the implied volatility is. Now, what's interesting is if we go to this shows implied volatility right here. Now, one of the things that is important to know is implied volatility typically increases as earnings approach. So if you look at something like Alphabet here, you can see here's earnings reports, implied volatility increased into the event. And here we have earnings coming up, in tomorrow afternoon, and you can see implied volatility is inching higher. So some of the kind of techniques that we look to use and consider using, work with this phenomenon. So there's going to be a drop of implied volatility after earnings, and that's something that our option strategies can look to benefit from. Also, we have to realize that if we want to be, say, directional on a stock, if we want to be bullish on a stock by buying an upside call spread or buying some kind of calls, we have to realize that the calls we own are going to automatically lose a degree of some of their value because of implied volatility going away. Now, if you're bullish, the intention is you're going to make more money on the stock jumping in value, and then it's the delta kicking in because the delta has that positive correlation to the stock. The hope is that the positive delta will make the options increase in value. But at the same time, we have to realize there is always that risk of the options volume dropping quickly. So we're going to get the vertical spreads because vertical spreads allow us to manage that risk by selling other options. So if we're selling options, they lose value also. And if you sell something and it loses value, then that benefits you because it's essentially being short something that loses value. And that's an important thing to remember. So I wanted to just also just highlight that this is on our chart. It's an easy way to kind of illustrate and see where implied volatility is at any moment in time. All right, now I'm going to bring up Option Station Pro. I'm going to show you another interesting, where'd it go? Another thing that we can do here. Now, you will notice on this workspace, I'm going to go back to my workspace here. You will notice on this workspace that I have these green S's. This is called symbol linking. And it means that when I click on a stock on the left here in radar screen, it will automatically load over here. Now, when it's this kind of symbol linking with kind of, more or less a square shape, it will only work inside of the same workspace. So these have to be in the same workspace to talk to each other. I can change that to work across multiple workspaces or across other applications. So I'm going to show you this now. If I go to this green S, I'm going to click on that and bring it down, and it says green local symbol link. I'm going to change it to green global symbol link. I'm going to do the same thing for my chart. And now I'm going to go to Option Station Pro, and I'm going to go up here and I'm going to click on green global symbol link. So now if I click on something, I'm going to just pull this down a little so you can see both. If I click on, say, Meta, you'll notice, you can't really see it very well. It's funny. Sometimes when you save something and then you reload it, it doesn't, all these things don't line. Anyway, you can see it automatically loaded Meta. So that was just an example of the sort of thing I'm looking for. So now I wanted to just show you, something that kind of just sprung, kind of popped up to me as some ways that options might be applied, in the current environment. So a vertical spread involves someone buying a call that is near the money. Vertical spreads involve buying a call or a put that is near the money and selling another one that's farther from the money. So for calls, it means you're buying something slightly above the current price, and then you're selling something higher above. And for puts, people are selling something that is lower, and they're buying puts that are slightly below the current price, and then selling another put that is farther below the current price. And this can capture moves between those two prices. Vertical spreads can generate leverage and help manage risk, but also limit profit potential. They can be useful during earnings season for both positioning and for hedging positions. So if you think, wow, I think Alphabet's going to have a great earnings report, or I'm bullish on this stock or bearish on that stock, a person might take a position using shares. The problem is that if it doesn't go the way they think, then the risk is very significant and they can lose a lot of money. With options, it allows you to pay a certain limited amount of money and capture the move that you define and that you think might happen. So we're going to look at some things that are kind of potential examples of that. And as I was looking, I've been looking at, like I said, I'm going to be getting to it with my later slide. But what I've been looking for were things where the MACD is moving in the kind of intended direction, and there's potential space in a given direction, like to the upside. And so, for example, one that was popping up to me recently, maybe the clearest example was actually Ford Motor. Now with Ford Motor, we have a recent rally, we have rising MACD. And so a stock like this is something that people might see is moving in a bullish direction with earnings the afternoon of the 24th, which is what, Wednesday, correct? Yep, it's Wednesday afternoon. So a person might jump over here now, for example, on Option Station Pro. And what makes this really interesting, you'll notice Ford already populated, is Option Station Pro basically allows you to very easily build the spread. So what a person could do is the stock is at $14 now. If we look at the chart, you look at a name like Ford here over time. What's interesting to me is that we have a level up here, around kind of 15.5. So a person might say a stock like this, maybe they're going to have a strong earnings report and they're going to jump from 14.5 to 15.5. That is a space to the, potentially in the direction we're looking for. So if we look here at something like Ford, we can say, well, if we look at the $14.50 calls, they cost 27 cents. A person could click on the ask, which is essentially saying that you want to buy it. And then you can scroll here to the 15.5 and hold down the control button and click on the bid, which means you want to sell it. And what that's going to do is it's going to create the spread for you right here in Option Station Pro. And what this is going to tell us is it's going to tell us that this spread would cost 20 cents. Now, if the stock jumps to that level or higher, the vertical spread will be worth $1, which means it could potentially make about 400%. Now, of course, that is a potentially large return, but it's a way for a person to play a potential move directly resulting from earnings. If it doesn't close above 15.5, on Friday, then the entire position, well, if it remains under 14.5, the position expires worthless. Once it gets over 14.5, then it starts to have value. But if it closes above 15.5, the full profit is realized. Now, a person might get assigned shares, which means that say the stock closed at 15, a person might get assigned shares that they have money in their account, and they're then going to be buying Ford shares. So if they're in this position and the spread is like in the middle between 14.5 and 15.5, say the stock's, like 15 or 15.20, then it could be assigned to them. So they need to realize that they need to exit the position if they don't want to end up owning a number of shares in Ford. But this is a way, for example, if they come out with a great earnings report, the stock jumps, then a person can capture that move with limited risk. And this is all about capturing the moves with limited risk. Another one that jumped out to me, it was very interesting, I've noticed this, is General Motors. Now, I will mention that, we're in the second half now. The first half of this year was dominated by AI stocks. I think that's a pretty, wide, everyone knows this. But, as you look toward an environment where the Fed is expected to cut interest rates and that sort of catalyst in the market, the potential of non-technology stocks to do better is, I think out there. A stock like General Motors and Ford, they trade for low multiples. They also benefit from interest rates going down because they themselves have a lot of debt, and also people use, financing to buy automobiles. As people have more optimism about, their ability to borrow and things like that, it's often going to be associated with something to be positive for a name like GM or Ford. So these are classic cyclical stocks, and it's interesting to see how well, especially Ford Motor, has moved to the upside as the market has priced in a September Federal Reserve rate cut. So I think it's important to realize here that if this trend kind of continues, this might be something people look for. They might look for these kind of traditional old-fashioned value stocks, traditional cyclical stocks to move. And what's interesting is that most of us think about the Teslas, the Nvidias, Apple and stuff like that for trading options. But the thing is, there are a decent number of non-tech stocks that trade a lot of options. And that's one of the great things about this indicator is it allows us to see here that Ford Motor is a pretty active underlier. We look here, it's not on this list, but if I go down here and I just kind of add it to the bottom, I can see that Ford trades 135,000 contracts a day. General Motors trades 37. So I can see right there, maybe, Ford is one that's more liquid. It allows us to quickly see that. But I wanted to point out here that that this is a way you can quickly see these things, especially using the average options volume. But let's get back to General Motors here, because General Motors also is at a spot where, when you look at it, MACD is essentially, not going up or down. It's not really giving us a strong downward sort of signal. And when I talk about a downward signal, I mean things like this. When you have this big drop in MACD, very often you don't get quick rebounds from it. It might rebound over time, but for options, when we're looking for relatively short-term moves, if we want to be long options, if we want to be spending money for a move, usually positioning against this sort of move in MACD, from my history of looking at the market, historically, you don't get the moves that will give you the extended move in your favor when MACD is moving against it. And so I wanted to just kind of emphasize that. In this case, we have MACD is not really opposing us. We have a stock that's making a series of higher highs and higher lows. It's above its 21-day exponential moving average. And so a person might look at something like General Motors, and they could say, well, let's see kind of where we are in terms of how much more space do we have to the upside potentially on this. And a name like this from here has potentially significant space to the upside. It basically peaked over 65 back in 2021 when the Fed was getting ready to start, hiking interest rates. And a person might see the potential for a move up into this space if they have a strong earnings report. So a name like General Motors here, the one that just kind of popped out in my mind was something like a person might, look at the 52, um, something like even the 52-56 call spread. Now, something like this, the cost of that would be 39 cents for a spread that is $4 wide. So basically, that is a potentially significant return if it was to expand to that amount. So I wanted to just kind of put that one out there as something else. That these are positions that if it doesn't jump to that amount, it does not, the outlay can be lost. However, when people are looking for kind of strong moves, sometimes this sort of positioning on earnings season can yield significant sort of returns. So these are the sort of things people might be kind of considering or thinking about. The other thing that's interesting to me about General Motors here is the when you kind of look at it, well, I had mentioned the 21-day exponential moving average. The other thing that's interesting is that you can see that it gapped on these higher on the previous earnings reports. So there's a company now that has been executing in terms of delivering results. If you also look, they have announced, they put the whole thing of that big UAW strike behind them. And they also at a spot now, if you look recently, they basically said they're going to delay electric cars and shift back to big gas guzzling V8s and things like that. Now, the thing is people like, the companies don't just make these decisions in a vacuum. They know where the margins are, they know where the opportunity is. And if they're going to shift in that direction, if General Motors believes that the traditional SUV market is strong now, I think it was for Escalades. They announced this last week. That is their bread and butter. They are not an electric vehicle company. They make SUVs. That is the thing that makes General Motors work. If they see that as being a growth area right now, with interest rates coming down, this is a sort of name that people might be looking to as they kind of potentially take profits in things like Nvidia or Microsoft or things like that. So one just kind of mentioned that. Another name that I was kind of watching recently, I did not see as much risk reward in this, but I did want to just mention that the solar energy stocks have been, really, they've been struggling for a while. But if you look at a name like Enphase here, it basically has moved sideways since October. And, this is an area here where it's had a period of consolidation within a downtrend, and people might be looking for something of this one to the downside. I want to mention that. Um, I also mention that I did not say this before, but on radar screen here, the other indicator I have is 21D, and that's basically the 21-day return, which is essentially how has the stock performed in the last month. So when you look at things like this, it allows you to kind of see stocks, how they are kind of just performing in the short term, essentially. And in my view, also, these are things that when you're looking to position, say, for example, to the upside, stocks that are down sharply in the last month. Something like here we have something like Micron. MACD is going straight down. Look at Micron here. You can see MACD has been falling for 18 days. It's down 20% in the last 21 days, the last month. So a name like this is one that, from my perspective, even if a person thought it was going to have some kind of positive catalyst, spending money on a vertical spread and something like this might not really work in someone's favor because of the fact you have this negative momentum. So the thing is to be looking for things that have the momentum kind of sliding in your advantage here. So one just mentioned that the combination of 21D and MACD cross days, those two things together are kind of, the things that I think are easy kind of go-tos for direction and momentum. So that's a vertical spread. Now, covered calls. Investors owning stocks can sell covered calls against their position. Covered calls earn premium and limit upside. So here's when we get into net delta again. That's kind of interesting. And let me just, all right, show you something. Now, as I looked at this, it's funny. The only thing right now that looked to me for covered calls that really looked that interesting to me was I want to just mention Walmart. This would be an example of one that if it had run a lot, a stock like this is something that people might look to sell what I would call I almost call it a bearish covered call. When a person sells in the money, calls underneath them. So basically, in my kind of way of looking at this, there's three forms of covered calls. If you sell calls that are in the money, they have the least upside and the least risk. At the money will capture the most premium, and out of the money has the most risk, but it allows the most upside potential. So a net delta can be a useful metric for these. So now, if a person owns 100 shares, that is equivalent to one call. So essentially, say a person, for example, Walmart is one I thought was interesting because I'll just quickly jump back to this. Back in May, we wrote an article about how Walmart had earnings coming. At the time, MACD was flattening out, moving higher. It had sideways movement. And if you look back on our blog on Market Insights on TradeStation.com, you'll actually see we did an article about this, about potential educational concept of an upside call spread in Walmart, and that spread did basically, it jumped up above that level. But the reason in many ways why it was potentially interesting was it had a previous strong earnings report. It had the neutral to slightly bullish direction, and it had space to the upside. It had moved sideways for a long time, and it had space to just kind of expand higher. It wasn't trapped in any kind of resistance. So that was an interesting one. But now, as we look at this, say for example, a person had bought the stock like around 60, or it's up at like 70, and they want to potentially they think I think it's done going up for now. I don't want to sell the stock right away, or I think it might pull back. What they could do is they could sell, for example, something like the $66 calls underneath that. So let's go over and actually look at this. But by the way, really quickly again, you can see Walmart here reports on August 15th. So let's just look at the August expiration on this. A person could go here to these. In this case, you have the August 16th expiration. A person, for example, could sell something like those $66 calls. Now, if they sold, now remember, they have to own the shares. You cannot sell calls if you don't own shares, unless you're extremely advanced and above really this sort of level we're discussing for this webinar. But a person, for example, say they owned 100 shares of Walmart, they could click on the bid, and they would be essentially saying, I want to sell shares. Now, in this case, my Optimization Pro defaults to 5 contracts, so I'm going to change that, to like 1. But what it would do is it would essentially bring in $5. And if you look over here to the left, you can see I have my intrinsic and extrinsic value. Intrinsic value means a kind of real value in the options, which is essentially the difference between the last price and the strike price. So the thing about a stock with an option with a lot of intrinsic value is the stock can drop all the way down before a person loses any money. So maybe they bought the stock at 60, it runs to 70. They then can sell the 66 calls. That stock, if they sell the 66 calls, they'll bring in, say, 510, boom. That cash is now in their account. And then essentially the stock could fall all the way back to like 66.5, and they'll lose no money, because what will happen is the calls they sold will lose value, because calls lose value and prices go down. So basically, they are hedged all the way down to 66. So that gives some protection against the pullback if a person had made money on it. Now, the problem is that if the stock goes to 100, well, you don't make any more money. So the thing is like I said, in this case, they have in the money calls have the least risk but the least upside. Now, how do we see that? Because if a person, for example, I'm not going to I don't have enough time to do this right now, but if you look at the delta here, the delta is 85. If a person owns 100 shares, that's 100 delta. So if I owned 100 shares of Walmart and I sold these puts, for example, my net delta would only be 15, which means my position would behave not like 100 shares, but like 15 shares, which means I've essentially eliminated, up to a point, my downside risk. I've eliminated any exposure to Walmart. It's essentially just flat. It's hedged. It essentially goes away well, not goes away, but it significantly reduces its movement down to 66. Now, if the stock falls to like 50, then basically under 66, then the profits start going away, and that's where the pain can start to set in. But I wanted to just kind of mention that it does have downside risk on a significant pullback. But the thing is when you have a scenario like this, selling calls under the strike price can be a method to basically manage the position and to capture a little bit of premium. In this case, a person would bring in 62 cents of extrinsic value or time value. So if they just sold those calls right now and walked away and say the stock closed at like right where it is, say it stayed at 70 until expiration, they would net an additional 60 cents, which is like 1%. It's not really what probably a lot of people looking to do who are active traders. However, it just kind of shows that it generates a little bit of premium. So now the other thing, let me jump back over here. At the money has the most premium in terms of, it doesn't have the most premium, but it has the most time value, the most extra premium. So say, for example, we look now at something like the 70s. You can see that the 70s have more, they have extrinsic value of 165, and they only have 59 cents of intrinsic value. So this is really telling us it has more time value than it has kind of real value. If the stock closes right at 70, what will happen is a person will collect that $1.64, and basically that becomes their profit, and it's pure time value. Thing is, if the stock jumps significantly, then they also have limited upside because they still have to sell the stock for 70. And if it falls sharply, then they don't have very much protection. They only have the premium they bring in. So a person looking purely to capture the time value would look to be selling near the money. Now, the other thing is, if a person is looking to capture time value, they actually would be looking at a shorter expiration. So now I'm going to show you this other delta called theta. Theta shows you how much time value you lose in a day. And I'm going to show fewer expirations, but if you look here, for example, you can see that the theta on these, well, in this case, these expire in 11 days, and they lose 4 cents a day. These both have the same theta, but look at the difference in the price. These here are worth 70. These are the $70 calls. And basically, these will lose 4 cents a day. And then these will also lose 4 cents a day, but they cost much more. So the thing is that the time value is greater that you lose in the short term. So people looking to purely harvest premium might want to be looking to sell calls that are closer in expiration. And in many ways, the fastest rate of decay for time value is about 2 weeks. So people looking to simply be selling calls to earn premium can be looking out for expirations in the next, kind of 1 to 2 weeks, depending on kind of what day you're starting on. All right, let me go back over now to my slide, and then out of the money. So say, for example, I'm going to look at maybe a different stock now. A person might want to look at something like NVIDIA, and they think, wow, I bought it at like 50. I'm up over. I've done really well in it or something. A person, for example, might be thinking, they want to give it room to run. So they might look at something like the 140s. I'm just looking at these as kind of like examples. Now, again, because we have our chart set up this way, you can see that the earnings date is estimated on the 28th of August. So we can now look for expirations that roughly match that. And here we have the 30th of August. And a person, for example, looking up to something like the 140s, I'm expanding this to see, you can see that something like those 140 calls, these have 42 cents of extrinsic value. So the stock at $1.23, and these calls are going for $4.15. A person, if they owned 100 shares of NVIDIA and they sold one of these calls, it would basically lower their cost basis down to about $1.19, which would give them a little bit of downside protection. The thing is, if the stock, say the stock does rebound and goes jumping back up to its 52-week high, they would profit all the way up to $140 and a little bit above. They could collect a profit up to about $140 plus the $420 they collected. So about $144 would be essentially their upside. Now, if the stock goes really to the upside, they're not going to make any money above $144.20, roughly. So that's important to realize. It has the most upside, but the most downside. The stock drops to 100, they're going to get basically very little protection. It's just going to go knifing down against them. So I wanted to just kind of point that out. Like I said, when it's out of the money, it has the most risk and the most upside potential. You'll also notice that these have the least delta. This has something like 30 delta. So if a person owns 100 shares and they sell one call, they still have exposure to 70 shares on a net delta basis. Their position will behave like owning 70 shares. So that's just a way to kind of use net delta to kind of envisage it. When you sell calls that are deeper in the money, you're going to have much less net delta. And when you sell calls that are farther from the money, much higher strike, you're going to have a higher net delta, more exposure to the upside, but also more potential risk to the downside if the stock does drop. Okay, so a person can look to hedge existing positions in two ways. Say, for example, you did own Nvidia, and you say you were lucky and you bought it when it was much lower, and now you think, well, I mean, I don't want to sell it, but who knows? Maybe it's going to have a big pullback. A person, for example, could look to the downside and basically do something like a put vertical spread. Now, I'm not going to go through all the steps of something like that, but the thing about a put vertical spread is that it costs money up front, which means that essentially, if the stock just moves sideways and nothing happens, the money you paid in the put vertical spread is lost. So it has an upfront cost. But the thing is, if the stock jumps a lot to the upside, you have unlimited upside potential in the underlying stock. So the best case scenario in something like, say you're long, let's just say Nvidia, and the best case scenario for the strategy is that the stock goes flying higher, and then you make more money to the upside on the stock than you would lose in the options going worthless. The other thing is the stock drops, and then your strategy pays off and protects you. Then at least you're making some money off of your strategy. The thing is that if the stock just moves sideways, then you don't make money on the stock moving, and you don't make money on the strategy. I don't want to say necessarily it's not best case scenario for your stock to fall, but in terms of the strategy yielding a return, that is actually how it works. It does not benefit from a sideways move. So if a person here thinks Nvidia is going to move sideways, a put vertical spread as a hedge would not maybe make as much sense as something like selling calls. A person, for example, could sell calls, at a lower strike, and they can be looking for something that still gives them a decent amount of extrinsic value, which is what Option Station Pro makes so easy to see right here. You can kind of see how much extrinsic, how much intrinsic, and you can kind of look right here as you go down to say, $13 below where it is, you can kind of see that you start getting a balance of how much premium you're going to collect versus how much intrinsic value you're giving up. So the Option Station Pro makes it really easy to see all these things. You also can adjust these columns. If you just click here on configure, it allows you to change the columns that you can see. I'm not going to get into that now. I want to just remind people that that is possible with this little wrench icon up here. So essentially, for people who don't expect much of a move, and this is almost just a universal sort of axiom of options, is that if you don't expect a big move, then selling options typically can make sense. And if you do expect a big move, then paying money for options makes sense. That's something that is largely true in the world of option strategies. All right, so I want to just kind of show some specific examples of things here that were interesting to me, and names I looked at. Like, for example, I mentioned Walmart. Now, what were the things about Walmart that made it interesting? Like I said, it basically had the things we're looking for to explicitly lay them out are a chart with space for moving higher, or if we're looking to the bearish, space to the downside. We want to look for the chart. We want to actually see that it has, that potential. And then MACD, we're just assuming bullish. You can flip this over for bearish. MACD flat or rising, and it's at or above the 21-day exponential moving average. So if you look at Walmart here, we're just kind of hugging this 21-day. MACD had stopped falling. See, here's a spot where MACD was working against you, but then it was kind of just nothing. And these are the sort of things that were interesting to me. And if you look, I don't know exactly what it was, but this was from April here to May 13th. So this stock was probably pretty much zero on the 21D. It was up or down a little bit. It didn't have any clear short-term move. So you had a longer-term uptrend and a short-term period of neutrality that, boom, could resolve to the upside. That was an interesting setup. Another one that was interesting was Meta back here. I'm sorry, Netflix, but I want to show you first. Netflix on January 24th. You can see here as well that this stock, no, here it is, right here, this one. All right, what do we have? We basically have sideways movement for the preceding month. It's at or above the 21 day, and MACD, you know, it was just kind of flat. I mean, if you look at it, it's not like knifing down. And I mean, MACD is one of these things that it is not really super precise, but the thing that is against this strategy is this an approach to something, that is when you have this kind of sharply declining MACD. This is essentially a kind of neutral move. So you have something here where you have a series of higher lows and a stock in that moment in time. If you look at it, a person could say it had space to the upside. There was no clear resistance on the left, and it had just this kind of space, and it resolved to the upside. So that's another example of a sort of setup people might want to look for. Then another one was Meta back on February 2nd. You'll also notice MACD was rising. It was above the 21 day. And at that time, it had just kind of moved up, and it was just kind of above its old all-time high. So all of these kind of have those different attributes to be looking for. Now, another thing here is that sometimes after earnings, what happens is stocks have essentially they have sell-offs on mediocre news, and people might be looking to kind of sell downside on those. So, and that's when people sell put spreads to the downside. And what's interesting about this is if you look, the thing that kind of grabbed my attention on this is you can see that RSI went to being oversold. So when people are looking, sometimes after earnings season, what I've noticed in the last year or so, a lot of the opportunities have come after earnings season when a stock has run a lot. And then what happens is the earnings are just mediocre and it knifes lower, but then a week later, it is held or bounced slightly. Those are the potential opportunities you might be looking for selling to the downside. So for example, if you have a bullish stock that is, kind of digesting and has some kind of drop, waiting for that move and then considering selling put spreads might be something that can make more sense than necessarily just saying, well, it's a bullish stock, so therefore I'm looking to the upside. People can kind of go both ways with this. Now, another one that was recently interesting was American Express, which basically went down and it hit its 21-day exponential moving average. You can see MACD was rising. Now, this is after earnings. It's going to show the earnings just came out. But what's interesting here is you basically have a stock that went down to hold its 21-day exponential moving average. And another one recently that was interesting on this was Wells Fargo. The earnings, had run a lot, and the earnings were kind of mediocre, but it went right down and held a support level and bounced. So sometimes, if there's no clear setup, the opportunity, and if you look at Wells Fargo, in my view, there was no really good setup in this one before earnings because it had this resistance to the upside. It was just kind of drifting. But then after earnings, it slammed down and a person could have been looking to sell, put spreads in it. So the basic idea is to kind of think both ways. When something is kind of drifting higher with potential space to the upside, people might be thinking about vertical spread to the upside. But when things are kind of range bound, the way a lot of these tech stocks appear now, it might be more of a kind of focus of people thinking about the potential for this period of kind of weakness and profit taking and rotation to maybe work out and give a better opportunity after earnings with some kind of, kind of puke to the downside or some kind of profit taking after earnings. And then people looking past it because there has been some really significant rotation in the market recently. I want to just kind of mention that because you can think both ways. You can be thinking about put spreads after or call spreads after. A person might be, if a stock has bad news and it rallies, off of a low, a person can be selling a vertical call spread to the upside to capture premium. So that is also another approach that people can have. So I wanted to kind of share those ideas is to realize that there's the pre-earnings when you have the short-term momentum working in your favor, but then also sometimes after earnings, you get that the counter trend move that can be an opportunity to collect premium. All right, so those are the main points I wanted to cover. Let's see if we have any questions. I think Jesus was helping to watch to see if we have any questions. Is there anyone who has questions, Jesus?
I don't see any questions here in the chat, so maybe this is an opportunity for anybody to ask questions if they have any. I'm sharing a link to our Options Education Center, which provides additional articles and strategies on different options. So make sure that you visit us and check those out.
Great. I'll also mention that if you go to tradestation.com and you click on insights, this goes to our blog where we cover a lot of different a lot of different trends and things in the market. And also we did something on TradingView. I'll just very quickly mention it's kind of an outside charting company that sometimes we work with on certain posts and things. But I want to mention this sort of rotation here, showing a rotation between semiconductors and banks. And just to kind of mention here that we're at a spot where the year has kind of entered the second half, and some certain rotation people have been kind of talking about. So I want to just kind of share this idea because it kind of explores some of those themes that we talked about here. But it's great to be with everyone, and also just mention that on Thursday afternoons we do a webinar at 2 p.m. Eastern called Market Trends, and you can sign up for that on the events page under the education section, the learn section. It's great to talk to everyone, and if you want to join, go ahead and sign up for that webinar on Thursday. And I hope to see you guys. Thank you very much.
Thank you, David. And also launched a little poll. Take a minute or two to answer some of those questions. It will really guide us in next upcoming education. Thank you for your time. Have a wonderful day, and I'll see you next time. Goodbye, everyone.